basically we have a hot economy. We're at full employment or better. We're seeing a slow but nonetheless identifiable increase in inflationary pressures. So the 2% intermediate term target is being reached, and in fact the New York Fed series of inflation data is punching through that. And there's one other factor at play here. We're running 9 years into the economic cycle. The record is 10 years, March of 91 to March 2001. Given the fiscal propulsion that we've gotten from the tax bill, and given the fact that regulation is much more business friendly these days and more financial markets friendly than it was before, you can see this cycle being extended. All of this gives either incentive or cover to the Fed to continue to ooch up interest rates in quarter point intervals in order to have something in their pocket to mitigate a downturn if and when that downturn occurs. Nobody knows when it's going to occur. And as I like to say, think of Jerome Powell as a giant squirrel. What he's trying to do is put as many nuts in the tree as possible so that it can be used to mitigate a downturn when the cycle begins to turn. At some point it will, it just won't be for some time. So I expect them to continue this path.
Right.
Go ahead.
How much of a puzzle, Richard, is it to you and do you think is to the Fed the fact that the economic indicators here in the United States have come in very strong, and yet we've got wage inflation, which is very, very muted, and yet a labor shortage in many areas of the United States?
Well, that's the issue. I mean, this question of the so-called Phillips curve, it's still there. We just don't know where the heck it is. And the fact is you're picking up a lot of anecdotal evidence, the fact that total compensation has to be increased. There's more competition for job. There are fewer skilled workers to meet those job demands. And logic tells you that we're going to see that kind of pressure. Plus, we're seeing, as was referenced earlier, pressure on the PPI. That was a very strong number. So I think you have to be at least aware of the fact that there are some subtle inflationary pressures being built. But again, this is a risk management exercise, and what you want to do is take advantage of the current hot economy, keep raising rates without tripwiring anything, and storing those nuts in the tree. In addition to the fact, by the way, the balance sheet is being reduced. It's already started that process. Some $300 billion so far this year, or will be this year, then another $600 billion per annum going forward. You get the balance sheet at the end of 2020 down to about $3 trillion plus. That's a tightening measure as well. And you can use that if needed, if you don't have enough rate cuts to mitigate a downturn, if it occurs earlier, by expanding the balance sheet once again. We established those principles, and it can be utilized. But that's the last resort. You really want to use rate cuts, and you have to have them in order to cut them.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.